ETFs are shaking up the investment landscape like never before, making it easier than ever to build and manage your portfolio and your retirement money. This applies equally to everyone from institutional investors to financial advisors with a client base, all the way to individual investors who make their own investment decisions. Mike Akins with ETF Action joins me. Stick around. I'm Ron DeLegge. Great to see you. Joining me today is Mike Akins, the CEO at ETF Action. You've seen Mike on my program ETF Battles, which airs right here on ETF Guide TV. He's one of our trusted judges. He's also one of the great minds and innovative thinkers inside the ETF marketplace. Mike, it's great to see you again. Thanks for being here.
It's great being here, Ron. Appreciate the opportunity to talk to your audience today.
Yeah. So as you know, ETFs are shaking up the investment landscape. They're making it easier than ever for everyone to build and to manage investments. That applies equally to whether you're an institutional investor or financial advisor with an active client base, all the way to individual investors who direct their own investment choices. So let's begin with, just the idea of just all of these ETFs. I mean, we've got over 3,000 listed ETFs, and it keeps growing each and every day. And it's really become kind of confusing for some investors how to map and monitor all of these funds using the appropriate benchmarks and the things that they should be looking for. So talk to us a little bit about what you use over there at ETF Action to kind of dissect through all of this chaos.
Yeah, so it has gotten crazy, right? We've gone from that first ETF back in 1993 all the way up to today, where we've got 3,000 plus ETFs, over $7 trillion following those ETFs. And I think the first great thing, there's a lot of great things about ETFs, but one of the great things in my mind is it's a free way to map the markets, right? There is now an ETF that tracks nearly every liquid corner of the investment market across the globe. And if you have a process to group those ETFs properly, it creates a great monitoring system for idea generation, risk management, really being able to quickly and tactically adapt to the markets using that ETF wrapper. So, what we do at ETF Action is we go everything from kind of a broad-based classification system, which I'm going to hop into our system and show you, which really makes it easy to monitor the markets, the AUM, the flows, the number of ETFs in dozens and dozens of popular categories. And then as we go along in the discussion, show you, well, it's great that all these ETFs are classified and they have stated investment objectives, but boy, are they different. So if it makes sense, I can hop in and share my screen and
let's do it.
give you a sense of what we're talking about. We're on the ETF Action homepage. If you go to etfaction.com, you're going to get our welcome page. There's a whole host of information on our homepage about all the different tools and data we have on our site that folks can walk through. But what I want to do is talk about mapping the market. So all of our dashboards are free to anybody that comes to ETF Action, and they're really designed to be a jump off point into the ETF marketplace. Probably the most popular, it is the most popular starting point for our users, both free users and paid users, is our category flows dashboard. And all this does is it aggregates ETFs up into dozens of different categories. So when you land on this page, you start with this asset class overview, which is really going to break down the ETF market at the broadest level by asset class. So we can see equity, fixed income, commodities, and we can get a sense of how many ETFs exist for each group, how much AUM. If you go down below, you can get a sense of the growth over time, right? So to really illustrate that growth in the ETF market, going all the way back to 1993, you can see how the ETF market has evolved and where we set today at 7.5 trillion in AUM broken across those broad asset classes. You can also track the flows. So you can get a sense of investor sentiment. So this is at the highest level, but really where it starts becoming powerful is when you start breaking it down into multiple categories. So if I use this drop down here, I can see that we have categories from everything from tracking issuers to index providers to equities by market, by country, by region, fixed income by composite, credit, duration, you name it. We likely have a category for it where we've done the work for you. We've bucketed these ETFs. So to kind of give an example of how that might work, I can use one of our really narrow groups, the equity thematic group. When I open this up, you're going to find out, well, in general, thematic ETFs have been out of favor year to date, right? We can see that $2.7 billion have flown out of ETFs year to date. That has changed recently with almost $1 billion flowing in over the last month, but it's not that way for all categories. So if I sort by flows in, I can see that $1.27 billion have flown into the robotics and AI category. Not surprising. We know how popular AI and robotics are. So I can see that that's an area where investors are very interested. I can see that.
Go back a second here. You had clean energy there.
Yep. So if I look, clean energy has actually had a lot of outflows. So you can see it's the #1 outflows.
What is the matter with you investors? I mean, clean energy. I mean, this is one of my favorite. Maybe it's because I'm a contrarian, but goodness gracious, what's the matter with you people? I mean, this is where they should be investing. This transition from old energy, legacy energy to clean energy. I mean, that's obviously it's a long-term time horizon, but this tells me that investors are clearly impatient,
Yeah, I think, the historically good, bad, ugly. The reality is that investors chase returns. And, we actually at ETF Action for some of our enterprise clients, we put together contrarian flows reports because what you often find is that the time to start thinking about a category is when flows are coming out. Because markets are just a measuring stick, right? And supply and demand from that standpoint, when you have a lot of flows coming out of a category, it's going to affect the prices of that category. So it can be an opportunity to think about an entry point if other things are met. But yeah, it's a good observation on your part to see how much money has flown out of that category.
Now let's get a little bit more granular. Let's talk about what's really in an ETF name, because there's a lot of the cute labels given to ETFs, and they all have these different investment objectives. You really have to, as you have said multiple times on ETF Guide TV and on ETF Battles, to look underneath the hood. What are some of the key data points to understand and analyze before making a decision for investors? What should they be looking at?
Yeah, so it's a great point, and maybe just to stick with kind of the theme here, I was talking about robotics and AI, so let's use that as an example to walk through some key aspects to understanding why you'd want to really look under the hood of these ETFs. So all of our dashboards are integrated to our ETF databases. So I'm just going to select this Industrial Revolutions Robotics AI, and what it's doing is it's passing through filters to our database to isolate those 10 ETFs in our database so we can really kind of dive in. First thing I'd note, this is a thematic category, so your expense ratios are usually higher. You can see that average expense ratio for the category is 64 basis points. And down below, I can see that ranges anywhere from, if I sort by expense, anywhere from 95 basis points at Robo all the way down to 47 basis points to iRobo. So that's one thing you're always going to want to look at. Now, you've heard me on the battles. When you're talking about thematic ETFs, I do not think the most important thing to think about is expense ratio. It's really about, does it align to your needs? But there are a few things I like to look at. And number one, I want to look at viability of the product, especially in the thematic space. So I'm going to sort by AUM here, and I'm going to show folks, we can see that a lot of these ETFs are very, they've got a good chunk of money in it, right? Global X is the leader in the category with $2.5 billion in their product. Robo Global is right there at 1.5. ARC, not surprisingly, at $1 billion. But you get down to some of these, and you may want to put them on a watch list. You may really like them, but at $2 million or $1.73 million, under $1 million, there has to be a question of viability long term. And you don't want to be in a situation where that ETF gets shut down on you and you get a distribution. You'll get all your money back, but it will come in the form as a distribution. Return of capital. So that's one thing I definitely look at, is that kind of viability.
Yeah, what's interesting to me about this data that you're sharing too, these three funds that are the top ones by AUM in this category are all way above the average expense ratio. That's just interesting to me how I guess there's some inefficiency sometimes with these markets. Like they're not necessarily the low expense ratios aren't necessarily the most important thing, I guess, for certain investors when you start to get down to these categories. Would that be a fair assessment?
Very fair assessment. And one of the things to note about that is the next thing I would look at beyond AUM for viability is trading and liquidity, right? So Bots may be a little higher average of the expense ratio at 69 basis points versus a simple average of 64 for the category. But my ability to trade in and out of that, I'm paying a 1 basis point spread.
Yeah.
Right. It's trading over $47 million notionally every day, 1.7 million shares. I know that I can get in and out of this product very efficiently. Whereas you get down to some of these others, you're going to have to work to make that trade.
Yeah.
To not have to pay too much of a spread. And that spread is a cost as well. It's kind of that total cost of ownership, getting in and getting out of the product, how much more you have to pay them, it's fair value. So that's number 2 that I would look at. And that's just kind of, does it meet the smell test type of stuff? Then we get to kind of get into the fun stuff, really looking under the hood of the product. The first thing I like to look at is just kind of the breakdown of the ETF from an exposure perspective. So looking under the hood, looking at the averages of the portfolio. I'm going to start with this category with market cap exposure. And I want to illustrate how different these products are. So what I'm going to do is I'm going to sort this by weighted average market cap. What is that? All we're looking at is the size of the company's weighted average within the portfolio. And what we can see is there is a huge difference, right? Chat, the newly launched ETF from Roundhill, has a weighted average market capitalization of over $550 billion, meaning that on average,
goodness.
right?
Wow.
So, and we'll go into that and look at that in a second, but it tells me we're talking really big companies, Google, NVIDIA,
Yeah,
Microsoft.
so basically you're talking mega caps.
Mega cap nominee, exactly. And then if you go all the way down to the bottom end of the section, the S&P Kensho by ProShares here, that index is clearly going down market. Right? It's got a weighted average market cap of 27 billion. If you do it at the company level and aggregate it up by groups, you can see 26% large cap, 38% mid cap, 20, it's a very total market exposure. And then you've pretty much got everything in between. So you have to ask yourself, why do I want to invest in this space? Number one, do I believe that the leaders and the best returns are going to come from the top of the market? Or do I believe that there's probably a better opportunity going downstream further and grabbing some of those smaller companies? Personally, I would probably be looking in the middle, like a bots or a robot.
Yeah, I'm with you. I think the opportunity is not with the already established giants who are already mature, but the companies that are maybe the next tier below that.
Exactly. So that would be one thing I'd look at. Another thing I'd start looking at then is valuations and growth metrics. And I can do this aggregated at the ETF level, but I also would definitely want to do it at the ETF level. So a lot of these probably own enough companies that are unprofitable that they may not even have a PE ratio. Oh, they all do. So we do have a PE ratio, meaning that enough companies underneath the hood are profitable so that we can calculate a full PE ratio. But I like to look at price sales when I'm talking about the growthier end of the market. And I want to know, how expensive is it for me to get into this product? So I can kind of dive in and see, you've got really runs the gamut from pretty expensive at 6.6 times last year's revenue all the way down to 1.6 IRBO.
And that one's called the intelligent machines. Maybe not such an intelligent choice from a valuation perspective.
Right. Well, it depends, right? I mean, you can also dive in. You can see, I look at kind of forward, you can see that clearly it's got a very high growth rate because it's going to go from 43 trailing to 33 based on estimates. So there's a lot of things to uncover there. But really with these thematic names, what I want to start doing is looking under the hood. So let's just take an example, right? Let's start with, we'll go with bots to kind of give you an example. So I'm going to click on bots. You can look at all kinds of analysis, but really what I want to do is kind of look under the hood. I want to know what are the companies I'm owning. So I'm using our portfolio visualizer to dive into the companies, and I can see, okay, there's 40 stocks in this portfolio. I can see that's definitely weighted by size. I can see NVIDIA here as a big company. It's got one of the higher weightings because this heat map is scaled. Note that it's looking at yesterday's returns, but if I wanted to get a sense for how these names are doing year to date, not surprising, right? We know these companies are doing really, really well. So year to date, some big returns here in the portfolio.
And I like too how you've done it by industry sector too in the upper left corner. That's a
Yep.
pretty
So
neat little
you can
feature.
group it by sector, country, region,
Yeah.
industry. And it gives you a kind of a sense of that makeup. Of course, I could go in here and I could look at things like analyst consensus ratings for the companies and see, some of these companies have huge, impressive target price implied returns using the consensus average of all the analysts covering it. And some have gone so far that price targets have gotten out of control. But as a whole, most of the portfolio is positive. I won't spend much time here, but it's just a sense of one of the really big benefits of ETFs is they're telling you what they hold every night. So if you have a way to grab those, you can really understand the portfolio. Now, talking about all of these have AI or robotics in their name, but as we can tell, if we were to look at performance, we can tell these returns are very different year to date, right? So they've all done pretty well, but there's a wide gap. So I know that we're not holding the same stuff. So I went to my performance tab. I'm going to look at this and I can say, year to date, bots is the top performer. It's at 41%. And then there's a couple that are brand new, don't have a full year, don't have a full return yet. But the ProShares is only up 25%. That's not surprising if we think about what we just talked about in size, right? So that ProShares ETF going down market, we know that this market this year has been led by the mega caps. So not surprising to see that. It's not necessarily something that might actually be a contrarian to think, well, actually, I want to get into the smaller names that haven't gotten as much appreciation. But it's just I'm using this purely to illustrate how much difference there is in return.
Yeah.
So let's talk about why that might be. And I'm just going to use a handful of these, the ones that have more than a full year, 1 year return. So I selected 8 out of the 10 ETFs here. And what I'm going to do is I'm going to use our overlap analyzer to illustrate that even though they all are getting grouped into this AI robotics category, we are talking about very unique strategies. So what I did is I just went to our fund overlap tool.
I'm going to like this tool.
So what this tool is going to tell you is how many names are in common with every product and what percentage they have an overlap. And when you think about overlap percentage, it's actually the reverse of active share. What it's saying is, let's assume that bots and ARKQ both owned Apple, and bots owned 2%, ARKQ owned 1%. The overlap would be 1%. What our tool does is it goes through every single iteration of all those products and tells you the overlap. And green means there's not very much overlap. So there's some categories where I can run on this and it'll be all red. But you can see that these are very different products.
So for example, just give us an example here. You got at the very bottom, it seems like Mac X has a lot of green.
Yeah, so it's all green across the board pretty much for all of these. Yeah, you can see it's only got 4 names, 8.8% in common with bots. 5 names, 7.4% ARKQ, right? So very, very unique, despite they're all kind of being the same. BULD is its highest with 25%. That they're going to start having some similarity. Another way to think about it is number of funds held. So 218 companies that are across these 8 ETFs that I selected are only in one of the 8. Wow. So literally no overlap at all. You have another 48 names with 2, so on and so forth. And then actually there's only 6 names that are held in all 8. And I would tell you those are probably going to be the highest opportunities. And if I scroll down, I actually get a breakdown of this.
Of the companies, yeah.
Yep. So NVIDIA held in all 6 with an average weight of 3.65%. If I open that up, I can see, okay, 13, the global X product,
who has the biggest allocation?
Exactly, right?
Wow.
And that's going to kind of lead to helping understand a little bit those portfolios. So there's a number of different ways to think about this, but
that's a really, really cool tool. And it gets back to what you were saying originally, looking beyond the label and really understanding what's happening inside the portfolio.
Exactly.
Well, let's shift to talking about some investors like to use ETFs besides building portfolios. They'll use them to see what's inside the portfolios, maybe for something like selecting individual stocks or doing more research on individual companies. Talk to us a little bit about that and how ETF action can help.
Yeah, so that's really one of my favorite things about ETFs is I've been in the industry quite a long time. I won't say how long because give away my age, but I've watched as technology and data has become kind of commoditized to a certain extent, and ETFs have been a big part of that. So it used to be if you wanted to get companies inside of the S&P 500 or companies in Europe or Asia or wherever it may be and do an analysis on that, you'd start with an index, and it costs a lot of money to license those indexes. Well, now there's an ETF that tracks those indexes, right? So we can reverse engineer ETF holdings to come up with select lists to do research on and come up with stock idea generation. So let's just stick with the theme of the day. I'm going to go to my interactive tools. I'm going to go to our ETF stock screener. And what I'm going to do is those 10 ETFs we were just looking at in robotics and AI, I want to go in and look at those companies and see if there's any that really jump out at me. And I'm going to do that by focusing in on those companies that are held across the vast majority of the products. So if I'm going to go into my thematic category, I'm going to go, I know that I have robotics and AI and industrial revolution, and I'm going to go into robotics and AI. There's those 10 ETFs. You can see $6.2 billion tracking them, 10 ETFs. And I'm going to click this load ownership data, and it's going to instantly tell me, hey, there's 332 stocks across those 10 ETFs. And I can see again, NVIDIA, 80 Autodesk are an 8 out of 10, 3D Systems is in 7 out of 10. What I would like to do is I want to avoid the noise, and I want to focus in where there's consensus that these are really AI or robotics names. So you can see by filter by number of funds, there's just tons and tons of names that are only held in 1 out of the 10. So what I want to do is set a filter and say, hey, it's at least got to be in 3 out of the 10 for me to think about doing research. And since I'm doing individual stock research, I'm going to say that, hey, the exchange country has to be US, because most folks aren't going to buy a single foreign company in their brokerage account. They're going to find an ETF to use to do that instead. If it's not at least listed in the US, it could be an ADR, but if it's not listed in the US, we all know the brokerage costs can be pretty prohibitive for foreign. So I'm going to say, hey, look, I want to break this down by exchange country, and I can see all the different exchanges that exist, but I'm going to go and say it's got to be on a US listed exchange. All right, so now I'm down to 46 companies that met those 2 filters. Let's get to work. So I'm going to use this launch portfolio visualizer, and it just loaded up into a portfolio for me every single one of those companies that met my screens, and it weighted them by their market capitalization. For illustrative purposes, I'm going to change that and weight it equally so we can get a better feel for the names. I'm going to just take a look at kind of my year-to-date returns. Not surprising, right? Vast majority of the names are up quite a bit on the year. Only a handful of outliers that are negative on the year. And I can see all the different names that came in there. So what I could do here then is say, okay, well, let's take a look at valuations for all these companies, right? So I could come in here and be like, let's look at forward sales estimates, price to sales. And, not surprisingly, we can see NVIDIA, right? It's trading at 17 times their estimated sales of next year. That's pretty aggressive. Not surprising considering NVIDIA is up, 220% year to date. Potentially it's gone too far. It's, evidence would say that when you get that far extended, it may not be a good time to entry point. I'm not making that suggestion to your audience. I'm just illustrating that this is a great way to get started looking at these portfolios, and you can start finding opportunities that might be more fairly valued and filter on price sales. So I could say, I don't want anything that's above 10 is too high for me to look at right now. So I'm going to go 10, and then I might start looking at my, my sales growth ratios and look at where I'm looking at on sales growth, or look at my earnings estimates. I can start really diving in and seeing where those opportunities might lie, or, I can dive in and really read about the companies, right? So if I just scroll through this, a lot of companies I know in here, but, I might want to read a little bit more about Trimble. So I could dive into Trimble and read about that company, get a link into their website, really dive into their financials. But that's the idea of the ETF market. To come up with a list of AI names is not exactly easy. unless you have access to taking advantage of it. And think about it. These are really sophisticated companies that have taken the time to build an index to track in an ETF. And because ETFs have to provide their holdings every night, I can then reverse engineer that to come up with my own lists of companies to do additional research and potentially come up with some individual stock ideas.
Yeah, well, that's very well thought out and shows how multi-layered ETF action is. The fact that you are showing at a very high level what the ETFs are doing, obviously by asset class, and then getting even more granular, getting into the sector exposures, and then the individual stock research, which is incredible because, ETF action, it just shows it's more than just, an ETF platform. It gets very layered.
And I think that's what's great about that is it's because the ETFs are more than just ETFs, right? I think of ETFs as an investment vehicle, a research vehicle, a portfolio completion vehicle, a screening vehicle, a monitoring vehicle. The ETF, there really is so many use cases for the ETF marketplace because of their transparency, because of that really efficient wrapper of putting these groups of companies inside of it. With the right tools, the right data, it can really enhance the way investors of all skill levels go about investing in the markets.
How do people set up a free account?
Great question. So if you come to etfaction.com and you are not logged in, do not have an account, you will come to ETF Action, you'll land on the homepage. You literally just hit sign up, put in your information, tell us you're not a robot, and you'll get an activation email, and away you go.
Okay.
When you're on the site, note that you don't even need an account to explore the dashboards. You can just start exploring those immediately. Once you want to go beyond the dashboards and get into the databases, you can see that I'm locked to get into the databases. A free account will unlock the ETF database for you. So you don't have to pay anything. You just have to create that, sign up and create that account. And then of course there are multiple tiers to it. But I would say just from a general standpoint, there is a vast amount of data that we provide for free within the ETF database for a free account. So would love for your audience, if they have the opportunity, create an account and do some exploring.
Yeah, for sure. And I think next time we have you back, we can talk more about the portfolio construction aspect of ETFs, because I know that you have a lot to say about that.
Yeah.
And the tools that ETF Action also can help at that level also. Yeah,
that's really where you start, you kind of go from ETF 101 to 102 to 201 or whatever it may be. But building a diversified portfolio that meets my investment ideology, my macro assumptions, my client needs or my own personal needs, that's when the magic starts happening. And obviously it gets confusing. But again, because ETFs are so transparent, I can group 20 different ETFs together and view them as one single portfolio and know how I look relative to a broad-based, 70-30 portfolio or a broad-based 20-80 portfolio, depending on my risk tolerances. And that's really where you can start having fun to optimize these strategies to work for what you need, whether it's more income, if you're younger and you want more growth, really start plugging and playing ETFs to make a portfolio that aligns with you.
Absolutely. That's when the ingredients start to become a meal.
That's a great way to put it.
Mike,
now I'm hungry.
Yeah, I'm hungry. Let's get some food.
Yes.
Mike, thanks for taking the time, and look forward to having you back. And again, for our audience, check out etfaction.com. We've got links in the comment section or description section below, and we'll see you on the next episode. Take care, everybody.